March 18th, 2026. Egypt has $48 billion in foreign reserves, the 12th largest reserve cushion in the developing world. 3 weeks earlier, it was $52 billion, a record. The government had just announced it. The central bank had published the number in an official press release, and the prime minister is standing at a podium, announcing the lights will be turned off. Not metaphorically. The street lights, the mall signs, the cafe windows, all commercial establishments, closed by 9 p.m. Then he says the number. Egypt's monthly gas bill had gone from $560 million to $1.65 billion in 1 month. You'll find on Egypt's 2026 currency crisis tells you the same story. A regional war disrupted gas supplies, the pound collapsed, the country entered emergency rationing. That story is not wrong, but it is incomplete. Because 8 months before the first missile was fired, a document existed, free to download, written by some of the world's best economists. It described, in precise technical language, exactly how Egypt's reserves could be swept away. It named the structural traps. It listed the vulnerabilities. Nobody talked about it. This video is the forensic reconstruction of what that document said and what the balance sheets of Egypt's own commercial banks confirmed before the war gave everyone an easier explanation to reach for. What was actually written in that document, the one available for free online, that described how Egypt's reserves could collapse before any war began? To understand what happened in March 2026, you have to understand what January 2026 looked like. Because January looked fine, more than fine. On January 31st, the Central Bank of Egypt announced that net international reserves had reached $52.6 billion, a record, the 12th highest reserve cushion among developing economies. Inflation had been falling for 6 months. By January, urban inflation had eased to 11.9%. The pound had stabilized after years of painful devaluations. Egypt's stock market, the EGX 30, had gained 49% over the previous 12 months. Foreign investors were moving money into Egypt, not out of it. They were buying treasury bills at yields above 25%. The carry trade, borrow dollars cheaply, park them in Egyptian T-bills, collect the spread, was working beautifully. Between $45 and $50 billion in what analysts call hot money had flowed into the Egyptian financial system. The government was building a new administrative capital 30 miles east of Cairo, government ministries, towers, a brand new parliament building, infrastructure everywhere, the new Suez Canal, solar farms, mega projects. On the surface, Egypt in January 2026 looked like a country that had turned a corner. It had not turned a corner. It had borrowed its way to the edge of one. In July 2025, the International Monetary Fund published its annual economic health check on Egypt. It is called the Article IV Consultation, 47 pages, available on the IMF's website, free. IMF Mission Chief Ivana Vladkova-Halar led the consultation. Her team wrote that Egypt faced high debt, substantial gross financing needs, and domestic rollover risks as its primary medium-term threats. They flagged what they called state and military footprint, entities owned by the military operating in non-strategic commercial sectors, paying no taxes, invisible to the central balance sheet. They flagged off-budget entity risks, infrastructure spending that didn't appear on the government's official accounts, creating hidden debt calls that could arrive suddenly. The document also identified what Egyptian economist Khalid Ikram, writing in an academic journal in 2025, called extreme misalignment between loan repayment schedules and economic returns. The government had been borrowing money on short and medium-term schedules, 3-year bonds, T-bills, to pay for infrastructure with 40-year payback horizons. A new capital city doesn't generate tax revenue for a decade, but the debt to build it comes due in 3 years. This is called a maturity mismatch, and it is precisely the kind of trap that does nothing visible until something external forces the repayment clock. There was one more warning embedded in the data. Between 2015 and 2024, Egypt had quietly shifted from a natural gas exporter to a net importer. Its own domestic gas field, the Zohr field, once the largest in the Mediterranean, had hit a 6-year production low in 2024. To compensate, Egypt had been importing Israeli gas from the Leviathan offshore field, approximately 1 billion cubic feet per day. The country's energy supply had a single point of failure, and it sat on the other side of a geopolitical fault line. Former head of Egypt's Direct Investment Association, Hani Tawfiq, had warned publicly that the government's resistance to meaningful structural reform, specifically its protection of the military's commercial empire, left the state fiscally exposed. He was not the only voice. The IMF had said it. Academic economists had said it. The reserve number looked strong, but reserves built from hot money portfolio flows are not the same thing as reserves built from export income. One stays when the system is under stress, the other runs. February 28, 2026. That morning, United States and Israeli forces began military operations against Iran. By evening, Israel had halted natural gas exports from the Leviathan field to Egypt. Deliveries that had averaged roughly 1,000 million cubic feet per day dropped to 50 million. A 95% reduction overnight. The events of February 28th, which disrupted regional energy supply chains, forced Egypt onto the global spot LNG market the same week. Spot LNG is the most expensive way to buy gas. You are not a long-term contract customer. You are an emergency buyer, and everyone knows it. The gas bill calculations happened fast. The monthly import cost went from $560 million to $1.65 billion, a 194.6% increase in a single quarter. That number mattered for a specific reason. Egypt had built its reserve cushion through 2025 partly on the strength of one deal, the Ras El Hekma investment from the UAE, a large one-off payment. The monthly reserve growth from that period was now being consumed by a single month's gas bill increase. Portfolio investors noticed. They had placed $45 to $50 billion in Egyptian treasury bills, not because they believed in Egypt's long-term stability, but because a 25% yield was exceptional. That trade requires one condition. The currency must hold while you collect the yield. When it becomes clear the central bank cannot defend the floor, the rational move is to leave before everyone else does. Between March 1st and March 15th, EGP $210 billion, roughly $4 billion, left the Egyptian financial system. That's $266 million a day. Every day. For 14 days. The feedback loop was now self-sustaining. More outflows meant a weaker pound. A weaker pound meant the dollar cost of the gas bill rose further, which triggered more fear, which triggered more outflows. On March 9th, the Egyptian pound breached 52 to the dollar for the first time in history. The same day, the Ministry of Petroleum announced a 17% diesel price hike and a 30% increase in compressed natural gas. Inflation, which had been trending down, reversed. By February, it had re-accelerated to 13.4%. On March 18th, Prime Minister Mustafa Madbouli stood at a press conference and announced what had happened. He described the monthly gas bill. He announced the rationing measures effective March 28th, mandatory 9 p.m. closures for all shops and cafes, streetlights dimmed, government offices on remote work schedules. He said, "The world is currently facing a genuine global crisis marked by inflation and rising fuel prices. We are compelled under these exceptional circumstances to minimize the impact as much as possible." 18 days. From the trigger to the lights going off. What did 18 days of crisis actually look like for the people inside it? In the Cairo Bazaar, gold dealers were reporting something they hadn't seen in years. Not just buyers, frantic buyers. People paying $300 to $500 above the international spot price per ounce. By March, the premium had reached $500. This premium is not irrational behavior. It is a forensic signal. When buyers are willing to overpay 10 to 15% above global spot, what they are paying for is speed of exit from a local currency system they no longer trust. The premium measures the perceived cost of staying. Between January 13th and January 29th, before the war, still in the stable period, 21-karat gold in Cairo had already surged 15.8% in Egyptian pound terms. The market was measuring something the official statistics hadn't yet confirmed. Meanwhile, for the 70 million Egyptians on the subsidized bread system, the government held the line, at least for now. Supply Minister Sharif Farouk was explicit: "We will not raise the price of bread." The annual bread subsidy cost 120 billion Egyptian pounds. The government could absorb it, for now. But unsubsidized food was a different calculation. Meat prices in Cairo markets rose approximately 25% in early March. Fruit and vegetables between 15 and 30%. The minimum monthly wage was 7,000 Egyptian pounds. The urban living wage, as calculated by the Anchor Research Institute, was 14,624 pounds. The gap between survival and the official floor had been widening for years before the crisis arrived. Piyush Gupta, then a Citibank official in Jakarta, described what it was like to work inside an Asian financial institution during the 1997 regional collapse. He told Euromoney years later, "It was not like being a banker, it was like being a platoon commander." His team operated out of a conference room, mapping civil unrest coordinates against cash movement logistics. In Egypt's March 2026, Central Bank Governor Hassan Abdullah was managing what the IMF had prescribed as a flexible exchange rate regime, allowing the pound to slide daily rather than absorbing the shock in one discrete devaluation. The IMF noted the rate still fluctuates within a limited range, suggesting the central bank was still attempting to manage the descent, but was being outpaced by the speed of the outflows. On March 15th, Prime Minister Madbouli directed Egypt's banking sector to prioritize petroleum dollar imports over other industrial financing needs. Commercial banks, which by mid-2025 had already been investing heavily in government treasury bills rather than commercial lending, had no remaining liquid headroom to buffer the system. They had, in effect, been conscripted into government financing. When the crisis came, their balance sheets offered no cushion. Victor Niederhofer's choices in 1997 are worth examining as a precise historical parallel, a window into how experienced institutional actors actually behaved when the systems they trusted stopped working in Asia, not as a commentary on any situation today. Niederhofer held over $1 billion in Thai stock futures when the baht came under speculative attack in 1997. He believed the Thai market would hold. He waited for official confirmation that the situation was resolved. The confirmation never came. He was interviewed later, in an emptied mansion. His was not a failure of intelligence. It was a failure of timing. The exit that existed on Monday had a premium by Wednesday and was gone by Friday. Korea, 1998. The country had been in IMF receivership for months. Unemployment had doubled. The national currency, the won, had lost half its value against the dollar. The government needed to repay a $57 billion IMF bailout. And then, something happened that economic textbooks weren't built to explain. Across South Korea, citizens began forming what they called jewelry abolition societies. People brought their wedding rings, their heirloom jewelry, their children's first birthday gold sets. In Korean tradition, children receive gold at their first birthday. It is not decorative. It is a family's first expression of financial protection for a new life. They donated it to the state, voluntarily, without compensation at market rates. Cardinal Stephen Kim So-hwan, South Korea's first Catholic cardinal, donated the gold cross that had been given to him at his appointment. When asked why, he said, "Jesus gave his body. This is nothing. 3.51 million South Koreans participated. 227 tons of gold were collected, melted into bars, and sold for dollars on international markets. $2.17 billion was raised, approximately 10% of the IMF loan. The IMF, observing this demonstration of national cohesion, eased repayment terms. The full loan was repaid 3 years early, August 2001. Now consider what was happening in Cairo in January and March 2026. Citizens were also moving gold, in the opposite direction. They were buying it, paying $300 to $500 above international spot, not donating to the state, exiting from it. In Korea 1998, citizens holding physical gold used it to restore the system's credibility. In Egypt 2026, citizens were buying physical gold to escape a system they no longer believed in. Same metal, opposite direction. Two completely different readings of the same instrument. George Soros positioned himself on the other side of Thailand's 1997 baht devaluation. He held forward contracts to convert baht to dollars at 26 baht per dollar, before the official float. When the float came and the baht dropped, he converted $1 billion into 54 billion baht on the spot market, then used his forward contracts to convert back to $2 billion. He doubled his capital. Not because he was reckless, because he had positioned himself, before the official announcement, in instruments that were not denominated in the local currency that was about to be devalued. In Sri Lanka, 2022, a different kind of documented survival pattern emerged. The government, facing fuel shortages and economic collapse, officially implemented a 4-day work week and encouraged civil servants to grow food at home. Rural households with access to agricultural land had a buffer that urban cash-dependent households did not. When food inflation reached 57%, the family with a vegetable garden was not insulated, but they were less exposed. In Jakarta, 1997, a woman documented by journalist Richard Lloyd Perry in Granta magazine sold 3 kilograms of beans in a full day of work at her market stall. After the rupiah had lost 84% of its value, that day's income came to 1,500 rupiah, 15 cents. No financial instrument was available to her. No exit. No hedge. The destruction of purchasing power arrived completely and immediately for the most cash-dependent households, in every case where the data exists. The Egyptian government, as of late March 2026, was pursuing the IMF's prescribed path: exchange rate flexibility, subsidy rationalization, with bread explicitly protected, and a $2.3 billion IMF tranche released as part of the 4th program review. The same playbook had worked before, not perfectly, but it had worked. Argentina's Corralito in 2001 ended. Bolivia stopped its hyperinflation in 4 months in 1985. Iceland emerged from complete banking collapse in 2008 with less permanent damage than analysts predicted. The mechanism of recovery in most documented currency crises involves the same sequence: credibility restored through demonstrated fiscal adjustment, hot money replaced over time with stable investment, and an IMF program that creates external accountability when domestic political constraints prevent internal reform. The disputed question, and it is genuinely disputed, is whether Egypt's structural constraints are more severe than the program can address. The IMF itself noted in March 2026 that progress on divestment and structural reform has been mixed with notable delays. Carnegie Endowment analysts, using a broader measure that includes off-budget military entities, estimated total Egyptian external obligations at significantly higher levels than the IMF's official $165 billion figure. What the documented record does confirm is this: the structural vulnerability preceded the war by years. The Zohr gas field decline began in 2019. The shift from gas exporter to net importer was complete by 2024. The maturity mismatch in Egypt's debt profile had been identified in academic and IMF literature since at least 2023. The war did not create the trap. The war stepped on it. There is a document, 47 pages, published July 2025, available on the IMF's website for free in the history of any browser. It described the maturity mismatch. It flagged the off-budget risks. It identified the state's structural dependence on short-term capital flows. It named the vulnerabilities that would, 8 months later, become the front page of every financial news outlet in the world. The forensic evidence was not hidden. It was not suppressed. It was published, in plain language, by economists with access to Egypt's own internal data. The question this history raises is not particular to Egypt. It has appeared in Thailand in 1997, in Indonesia in 1998, in Argentina in 2001, in Sri Lanka in 2022. The pattern is documented. A country builds reserves that look strong but are structurally dependent on mobile capital. It borrows on short schedules to fund long-horizon projects. Its domestic energy production declines quietly while its import dependency rises. Then, a single external event, a war, a rate shift, a commodity shock, activates the structural fault. And the timeline from trigger to rationing is measured in days, not years. The IMF, Article IV Consultation on Egypt was not a prediction. It was a diagnosis, written before the patient knew they were sick. The lights went off at 9 p.m. in Cairo. The document that explained why had been available for 8 months. And I find myself returning to a question that the Korean, Thai, Indonesian, and Sri Lankan records all leave open. Could the same maturity mismatch pattern, a country holding record reserves built on mobile hot money flows, borrowing short to build long, appear somewhere else that currently shows healthy headline numbers and high yields? If you've watched a crisis like this unfold, from inside a country or from the outside, I'd like to know what the early signal looked like to you. Leave it in the comments.